is the Brookshire Moment, and I am your host, Donald Lowe. In today's show, we will be discussing the definition of principal, and our discussion today will be on the topic of loan applications. It's going to be a good show. Lastly, we will talk about and give you the real estate update, going through stats and where we are within the real estate world here in Utah. So get ready because it's going to be a great show.
Principal, the original sum of money that is borrowed in the loan.
Okay, hello everybody. We're here with Mike Talba. Thank you very much for having me here and being a part of this.
Yeah, thank you. I love doing this kind of stuff. It's great.
I'm excited. Today we're going to be talking about the loan application.
Yep.
And obviously that's important for anyone that wants to get a loan for their home.
Yeah. The word sounds a little intimidating though sometimes. Loan application. I'll be honest with you. I've been on the other side of that many times, and I'm like, ooh, what's they're going to pull my credit? There's things you think about.
Well, and for most, they really don't know what they're getting themselves into.
Right.
So
right.
I think this conversation's really good, so that we can talk about the loan, what's entailed, what's really going to affect the applicant. And why it's important to know this prior to even going for the application. So first off, what is the best or easiest way to fill out a loan application?
So, I've been on both sides of this. I have remembered in the past, before I was a loan officer, going in and applying for a loan, and there's a lot of questions on there. Things like, tell us about the assets that you have. Tell us about your liabilities, right? And I'm trying to remember. Well, I have this credit card, and I'm filling out all of this stuff, and in the back of my mind, I'm wondering, do they really need all of this? That's been a challenge for me, I'll be honest, as I've been on that side of it. Now, most of the loan applications are standard. You're gonna get asked the same questions no matter where you go, but the answer is no, we don't need all of that information provided in the loan application. We get that from other places in many cases. So the easiest way I would say to fill out a loan application is to do it with the loan officer. Okay. If it's sent to you and you're answering all the questions yourself, you're likely going to provide more information than what is needed. You may omit some information that is needed, and it can provide for a little bit of a frustrating process. When I take an application from my clients over the phone or on a Zoom call or however they prefer, or in person, takes me 13 minutes. It is super fast. And when you get to things like what are the assets, is a car an asset? Sure, you own a car, that's an asset. As a loan officer, do I care about your car? No, I don't care that you own a car. There's no value in it. What we care about is, for example, how much money you have in the bank for your down payment. That's the only asset we care about. Sometimes we care about that you've got a little savings outside of that. But in most cases, we don't need all of the other information that you would want to provide. Going to the liabilities, same thing. Do I need to answer, I've got this car loan and I've got this credit card payment and I've got this and this? No, I'm going to pull your credit and I'm going to get all of that. I don't need you to provide me that out of your brain. It takes me 30 seconds to get it all off of your credit report. So again, people generally, when they fill out that application themselves, they're going to provide way more information than what is needed.
Yeah, so the first time I filled out a application for my first house, I had to have spent at least 3 hours.
Wow.
3 hours, because I was trying to make sure that I gave every single detail that I could, because I didn't want to mess it up.
Yeah.
This was my first house, and I definitely didn't want to mess it up or miss getting the house.
Yeah.
So
that's interesting that you bring that up. I didn't think 3 hours. I was thinking it might take you 30 or 40 minutes to do it yourself, but 3 hours. So going back to it, the absolute easiest way, get with your loan officer, do it with them over the phone, just answer the questions. They're going to ask what's needed, and they'll get what's needed, and they'll omit the things that are not needed on the application.
I wish I would have known that. I wish I would have known that.
Yeah.
Okay, so what type of information will be provided or
Good.
needed
Yeah.
within the loan application?
So the first part of the loan application is going to be personal information. Your name, your social security number, birthday, email address, phone number. These are and your address. These are the big six. We're going to get that from every single person always.
Okay.
Once we move past that, then we get into job history. And this is important. A loan application is going to want 2 years of job history. So be prepared with, if you've been on the same job for the last 5 years, it's super easy. But I have filled out applications with people that have literally had 7 jobs in the last 2 years. And
Wow.
you're going to have to round that information up. You're probably not going to have that all in your head. And the start dates and the end dates of each job, and the address of the employer, and who and who we can contact to verify the employment. This is all part of that.
So how much detail do you need with that? Is it a month and a year for job history,
Yeah, it's
or is it an
typically-
exact date?
Yeah, the answer is that we're going to verify everything. So if you've got an estimate, start and end date, that's usually good enough.
Okay.
So we'll verify everything on that. We also are going to be looking for, there is a questionnaire at the end of the application that'll ask you things like, have you ever owned a house before? If so, who did you own it with? Have you filed bankruptcy, short sales, foreclosures? Do you owe any money to the federal government? Any lawsuits against you? So these are just it's kind of a yes/no questionnaire. These are called declarations, and those are part of every application. You have to do those part. You can omit the race and ethnicity if you want, but that's also asked in there. And let's see. And then the credit authorization. We want you to say, yes, it's okay to pull my credit, because again, that's where we're going to get all of the liabilities, all the debts that you owe, so that we can come up with this number that we call a debt to income ratio. And that is the number we need so that we know how much house you can buy.
Yeah. So and that's obviously very important, because if you can't afford the house that you're wanting, it doesn't matter, because you're just not going to have the money to get it.
That's right. And it's way better, and we talked about this previously, but it's way better to know that up front and not find that out after you go and fall in love with a house, you know, that you can't afford. So
Definitely. Okay, so what factors most influence mortgage loan approval?
yeah, I would say that there are 2 or 3 things that are super important. Income is critical. We've got to have an adequate amount of income. And I want to say this and then explain it. It needs to be stable income. Okay, I mentioned that I've done loan applications for somebody that has had 7 jobs in the last 2 years. Does that sound stable to you?
No.
And it doesn't to me, and it doesn't to the underwriter in some cases. In some cases, it's okay. You know, if you've changed jobs, and every time you change jobs, you've gotten a better one, and you're making more money, that's okay. But that wasn't the case with this other person. There were job gaps, and you know, the income wasn't going up. It was just, there was something else going on there. So we want stable job history and income that we can look at and say, yeah, this is a safe risk. They're going to be able to pay this bill. So income is critical. Number 2, credit is going to be critical. We pull that credit. We're looking for credit scores, ideally above 660, but we can go down as low as 600, and it gets harder, right? The question is, what most influences a mortgage? If you're above 7 or 660, you should be fine. There's a lot of wiggle room. We can do a lot of things. You go down below 660 and it just gets harder. The closer to 600, the harder it gets, and pretty soon you're not going to qualify. And then the other factor, so that we've got income, and then the last factor, down payment is also the other thing we're going to look at. Different loan programs have a different requirement for money. So we need to know that you have the money and we don't want to know where you have the money. If it's under your mattress, that creates some challenges. If it's
Because you can't prove it.
if it's in a vault in your house, in a safe, and you even if you took a picture of it, it doesn't, we can't prove it. So digital money is what we're looking for, and some loans don't require a down payment. So money is less critical in those types of loans, and we might even look at that type of loan if you have money, but not enough, or it's not digitally traceable. So those are the three things. It's credit, down payment, and income. Those are the main factors that we're looking at.
Okay. So there is one variation that I'm interested about, and that's the variation within the job markets. You talked about consistency within, the 2 years or, 5 years or what have you. But when you look at contractors, when you look at realtors,
Yeah, you're talking about self-employed.
Self-employed, okay. Is there any difference within the application that you have to be concerned about? Or?
Yes. With a standard W-2 employee, I work for, ABC, let's say ABC Engineers. And I changed from ABC Engineers to another company. And I did that last month. That's actually no problem with getting a loan. That's super easy. There's still some consistency. You were making this amount of money here, and now you're making roughly the same or maybe better here. There's no challenge there. When it comes to someone who is self-employed and you're working for yourself, now changing businesses is a problem. You don't. I was running this company and now I'm running this company. It starts all over. You're going to be waiting 2 years in most cases. There are some exceptions. You can go down to a year in some cases, but you're going to be waiting 2 years with that company, with a consistent income in that company for 2 years. And if your first year in business wasn't that consistent, second year was great, you still might not be able to get a loan, even though you got the 2 years, because you had a small amount of income in year number one and a big amount in year number two. We're going to average that together, and that might not be enough money to get you into the house you want. So contractors can be tricky. There are some unique programs out there for people like contractors that are self-employed, or real estate agents, or whoever that are self-employed. There are some unique programs where we can look at just 1 year, and so that might be the option. Typically, though, we're going to want to see a bigger down payment for people that are, the closer you get to a brand new business, the bigger down payment we're going to want. I've even got a loan that we can do for somebody they don't even have to prove income at all. There's no income requirement, but the down payment you can guarantee is going to be big. It's going to be a 25% down payment for something like that, which is fine. If you got the money but you don't have the income, if you have the income but you don't have the money. But if you don't have the income or the money, then you're waiting.
Then you're straight out of luck.
Yeah, then you're out of luck. So, yeah, there's a lot of different programs out there outside of the standard mold of loan programs that we talk about that are, but don't give up if you feel like you're in one of these situations that we talked about. There still may be something for you.
Okay. So to finish things up, if you were to give maybe 2 or 3 tips when it came to an application, what are the big pointers right there?
Tip number 1, and this is probably the most critical: if you want to buy a house at the end of this year, say 6 months from now, don't wait till the end of this year to get with a loan officer, especially if you feel like you might be marginal in your qualification. If you've got an 800 credit score, you've got $200,000 sitting in the bank, and you make $300,000 a year, you're fine. Just wait until you're ready and go apply. If you don't fit what you think would be the good mold, you want to get with your loan officer sooner so that there's some time to plan and make some changes. So that's advice number 1, get with your loan officer as soon as you can. And number 2, you want to create stability in what you're doing. So we talked about income. We want that to feel and look stable. Don't go opening up new credit lines and things like that. One of the big mistakes people make is they go buy a car and then they want to go buy a house. That in some cases that's fine. If you're that guy with 800 credit score and you go buy a car, no problem. But if you're the guy with a 660 credit score and you go buy a car, you're going to see a dip in that credit score, and suddenly you might have been eligible before and now you're not.
Not now.
So be careful of opening new credit lines, and then probably keep your money in a bank where it's traceable digitally. There are ways around to work through that, but that might be 3 tips that I would give.
Okay. Well, I think that's very valuable. I appreciate your time, and I think this is really good information.
Okay, thank you. Yeah, appreciate it. Have a great one.
Thank you. Okay, now for the market stats for April. Again, we're going over April's because they come in at the end of May, so it's always a month behind. The median days on market in April were 34 days. So that was the average amount of time most houses took. Median price per square footage was $233. The median sold price was $570,000 for a single family home. Homes sold in April, 3,369. Listings entered for the month of April was 6,028, which is about 900 more homes than the year before. Going on to the market monitor, we're looking at it still being a seller's market, but what we have is it's becoming more favorable towards the buyer, or it's moving that way in that there are more homes on the market. So the backlog of homes has increased, and because of that, things are becoming a little bit more equilibrium between a buyer's market and a seller's market. And you'll hear me say all the time that the sweet spot is when you have that equilibrium, because you're getting the house at the best price, and you have more options. You're getting the biggest bang as a seller to be able to sell your house, and more buyers going through to look at your house. But on the buyer's end, you have more options, and so it becomes a nice equilibrium. As far as interest rates, interest rate has on average has gone down a little bit, and we're looking at this from a perspective of an average interest rate in the state of Utah, and we're also looking at that it's a fixed 30-year. So the big difference between different products, but this is a nice indicator, and we're looking at about 6.8, 6.89. So it's dropping ever so slightly. My guess is we're going to see it drop a little bit more over the year, but we're actually not at a bad situation, having been that the 30-year average has been 7.8. So we're still under the 30-year average. So that is the market in a nutshell. We've got a lot to be excited about and a lot to be happy about. Things are looking good. The market looks healthy, and looks like it is getting healthier. So that's a bonus for everyone. Other than that, we'll see you next month. If you like what you see, remember to subscribe, like, and share.